In this video, we are going to provide a quick overview of alternative investments and the role they may play in a well-diversified investment portfolio. What is an alternative investment? Quite simply, an alternative investment is any investment other than stocks, bonds, and cash alternatives, or mutual funds and ETFs that only hold stocks, bonds, and cash alternatives. Some alternatives, such as real estate, commodities, and hedge funds, are available in a mutual fund or ETF structure, while others are only available in a private structure. In either structure, the level of complexity ranges between simple and easy to understand to complex and very difficult for the average investor to understand.
High net worth investors and large institutional investors, such as pensions and endowments, typically allocate much higher percentages to alternatives as compared to individual investors. The reason they do this is to potentially improve the risk-adjusted return of their overall portfolio by adding asset classes with performance that is not directly tied to performance of stocks and bonds. At Aristata, we typically implement some alternative mutual funds or ETFs in our clients' accounts where suitable, in an effort to help lower volatility in their portfolio and smooth out the ride.
When compared to mutual fund or ETF structured alternatives, those offered in a private structure attempt to provide higher average returns, lower levels of volatility, and additional tax advantages. But those potential advantages come with trade-offs. First, to qualify, investors must have a bare minimum of $1 million of total investment assets. And for more exclusive alternatives, that minimum is much higher. Second, these investments are more difficult to value, and values are usually updated monthly instead of daily. And third, they are less liquid and require a longer-term commitment. The more exclusive the fund, the longer the commitment. These private structure disadvantages mean they're usually only appropriate for more sophisticated investors with longer-term investment objectives.
Now let's look at an example of how this has worked. As you can see in this chart provided by JP Morgan, a 30% allocation to alternatives from 1989 through the third quarter of 2022 increased the return while reducing the risk when compared to traditional stock and bond portfolios. Let's look at just one set of the data pertaining to the moderate portfolio. Here, we find that the 30% allocation to alternatives increased the average annual return from 8.16% to 8.87% and reduced the volatility or risk while doing so.
As good as this may sound, alternative investments are not for everyone. But if you have an interest in learning more about private real estate, equity, credit, and hedge fund strategies, or would like to know more about how we utilize alternatives, please give us a call.